Hi, Philip. How are you?
I'm doing great.
Good. Just want to talk here briefly about the markets with you. We got a lot of action coming in really actually today. Tell me your thoughts really on the energy market, specifically oil. We've had some movement off the bottoms here in the last, probably last week. Just tell me your thoughts and what's the cause of that and where do you see this going into the rest of the year?
Yeah, the energy markets have been fantastic. Any kind of pullback you see in crude oil below $70 has been met with OPEC taking some more aggressive stance. We've seen Saudi Arabia recently cutting production voluntarily and then also extending those production cuts out. There was a lot of rhetoric about cheap Russian oil kind of floating around in different countries like China and India. What we hadn't seen is that Russia actually voluntarily cut 500,000 barrels per day, essentially putting a floor in on crude oil prices and then pushing crude oil from there. I think that it's been kind of a sleeper market. I think anywhere in the high 60s to mid 60s, I think is a great value zone for, looking for a year-end rally. We believe that prices could easily achieve $80 to $85, especially if you see the, recession fears go away and we see more of a soft landing and a recovery.
Got it. Well, let me ask you, I guess, to parlay with that, maybe this is a little more cyclical. Natural gas had an extreme sell-off here in the past few months, and then it looks like it's putting in a bottom here. And then plus we got the colder winter months coming up. They're in not the too distant future. Where do you see that going?
Yeah, I think natural gas, I think that could be another real sleeper market. It hasn't gone anywhere here in the past few months. The summer, I was kind of surprised that with some of these hotter temperatures moving through the Midwest and across the country, you would have saw a little bit more demand and a little bit more of a pickup. But I think that globally, I think natural gas supplies are adequate. I think that the war in Russia and Ukraine, they're not necessarily weaponizing natural gas like they did before. So we do expect prices to get some kind of rally into the back end of the year, especially if we get that colder winter. So I would look long term as far as positioning out in natural gas.
Got it. So speaking of which, also this is going right in the face of a supposedly slowing economy. How much it slows is really anyone's guess, and also the Fed being aggressive and raising rates. How are those factors going to impact the energy markets here, both natural gas and oil?
Yeah, so I mean, there's like every coin has two sides. So we're not quite certain as far as how long, what the impact of this recession. We do anticipate something will happen here, but the economy has been quite resilient. the labor sector has been quite tight. We've seen robust wage growth. We've seen the consumer has just been quite durable. Now the creditworthiness of the consumer, the belts have really tightened up on them. We think that corporate spending is going to come down, and we think that the effects of the longer lasting inflation, interest rates higher for longer, is going to ultimately weigh in. But as far as the way the markets are interpreting right now, look at the way the equity markets have rallied. Look at the way that the resiliency of crude oil prices and energy prices, if they were really factoring in this hard landing, prices should be significantly lower, but also OPEC has been providing that floor on the market. So I think we're more in this sideways cycle to slightly higher prices.
Yeah, I find that interesting too, is I was in a moderately bearish camp leading up into the summer, but again, just the economic data that we're seeing, it's maybe confusing, if you would. That's led to some shoppiness, but it just doesn't see this, drop, if you would, huge drop in the economic activity, which I expected that it would. So I'm actually becoming moderately bullish myself. So talk to me a little bit about the industrial metals. Assuming if we do get some kind of slowdown, I'm assuming they're going to drop more, but they still haven't really.
You would think
and
so?
Then go ahead.
I would say that you would think so. Like something like the copper market should be a lot lower, and it was
Right.
kind of surprising that we've been holding in the mid 370s for quite a while. Our clients, the way we're positioning is we're more focused on like China and China's economy, which has definitely slowed down. Just our latest inflation data came out with basically flat, showing almost deflationary pressures there. Well, I think that China really wants to try and drive their economy back higher. Goldman Sachs recently wrote a report saying that China's in a slowdown. China came out and said that that was essentially fake news, that, you know, they don't want that perception that they are slowing down. So what they're doing is they're taking small shots at some stimulus measures, cutting some of, helping prop up the property sector, cutting some of the interest rates just a touch here. And we do anticipate more stimulus will come down the road. So we think that, China being 50% of copper demand, we think that prices are going to naturally trend higher. Also, we do believe that the big push on EV vehicles, the green energy revolution, we think that copper prices should continue to push higher. Our year-end target is about $4, which would match the June high from over the summer. I don't know if we'll get back up to like 425 anytime soon, but if mining supply is unable to keep up with any kind of increase in demand, you're gonna see prices punch through that $4.
Got it. Do you have any view of really long term, let's say, so after we get over this economic, we have more clarity with economics, and and let's say the global market, equity markets start really to take off and the economies improve. What is your view on the copper market then? I'm assuming it would be very bullish.
Substantially higher. I really think that copper and gold, I think, are your two best metal plays. And, I know we'll get to gold in a minute, but the copper market, if you look at like LME inventories right now, they're like just a couple drawdowns from punching to like 17-year lows. And if you see that uptick in that demand, you could see how resilient just on a CPI print coming in lower than expected, the reaction function and the copper market jumping over 2%. So prices could really turn into a snowball effect. I really like any of these copper producers, and copper is a long-term play. Who knows, even the penny might come back to a full value of a penny at some point.
Right. Let's talk about the gold market and silver market, the precious metals. I did an interview maybe 2 weeks ago, and we thought we're probably looking into August for things to start perking up again. If you would, it looks like gold is putting in a floor around 1900, 19 and a half, if you would. Maybe silver around 22. But what do you see the gold and silver markets doing through the rest of the 2023?
So that on the gold market, that 1900 corresponds with the 200-day moving average. Market had bounced off that before. I think that when it starts to approach it, I think people look at it as like long-term value. There's a lot of safety there. U.S. equity markets up substantially, with the NASDAQ up 30-something% in the first half of the year. I think you got to take a couple chips off the table, start looking at things like bonds, looking at silver, looking at the gold market. So it was looking for a light at the end of the tunnel as far as the Federal Reserve continuously raising interest rates. Now that we're starting to see the inflation data come down, we've seen a little bit of weaker job growth. We've seen, we don't necessarily believe in the ADP number. The ADP number has been a little bit more volatile. The Fed utilizes, the non-farm payroll number, which has been a little bit more in line with the expectations, if not slightly weaker than expected. We did see a recent uptick in initial claims. So I think that definitely the floor on the gold market has been put in place. I think that prices are now looking forward out, like where we were expecting 2 more interest rate hikes now with the new latest CPI data. We got to check the CME's Fed Watch tool, see if that came down to just 1, or if it even cut those expectations in half. So the light at the end of the tunnel, I think you start positioning in gold, and you got to look at what is the next massive catalyst out there. Does not necessarily the hard landing scenario play out, but more that, that creditness of these, the consumer of companies starts to tighten up. It impacts GDP. And if you remember back in 2018, on the third quarter, that's when GDP had peaked. It started to come down. We also saw, that was the top of the corporate profit cycle, and that marked the bottom in the gold market. And the Federal Reserve, ultimately, they wanted to raise more but they ended up cutting 2-3 more times, and that marked the bottom in the gold market at 1,050, and it went on this massive run up to 2,000.
Yeah, about that. The question I have, or maybe not a question, it's just a hunch or observation I have, is going into 2024 is obviously an election year, and you as a student and trader of the markets knows what that means. It's probably going to be a lot lighter Fed dealing with that. So yeah, what are your thoughts on that and comments on that? It should be a good year for commodities going into 24.
So if you look at the current administration, what would their goals be? They would want to have a robust economy. They would want to alleviate some of the strain, especially like, they weren't able to pass that student debt relief, things like that. They want to get rates back a little bit lower. We do believe that in that first quarter, you're going to see GDP contract. We think that rates will naturally start to come down from there. And that's why I think that gold gets actually a tailwind, and that's how we get to like 2,500 in the next year. So I know that with each, candidate, and we've already experienced, former President Trump already before, it tends to get a little bit volatile and he tends to get a little bit more heated. So we'll see more action in more volatility, at least in cross assets, kind of not only in the US, but across the globe. But I do believe that, gold is going to give you one of your best opportunities. The same thing with that copper market.
Excellent. Well, I'm talking here with Phillip Streible, who's the Chief Market Strategist for Blue Line Futures. How can people get in touch with you, Phillip?
Yeah, the best way is to go to bluelinefutures.com and register for a free 2-week trial of the Morning Express. We basically put out a playbook here on what's going to happen on a day-to-day, and it has some of our bias and some of the actionable trade ideas in the precious metals and industrial metals markets.
All right. Thank you so much for your time. And yeah, we'll have you on again here pretty soon. Appreciate it.
Thanks for having me.
You bet. Have a good day.